Hello investors, welcome to Simply Stocks. In today's video, we will talk about the most important topic related to investing, which is exit strategy. Just as it is important to enter a good company at the right price, it is equally important to exit from that business or sell it at the right time. Otherwise, you will see that whatever profits you are making will not stay with you. You will end up getting back at zero. A good exit strategy gives you two benefits. First, you get to save the profit or return you have made. Secondly, if you are at loss in some company, your remaining capital gets saved. So in today's video, I will discuss 6 very important exit strategies with you. During this conversation, we will also look at many examples and cases. But please note, this video is in no way a buy or sell recommendation for any of these businesses. With that being said, let's begin. First, let us understand why exit strategy is important. For this, I will share two cases with you. For the first case, I have this chart of Vari Renewable Technologies with me. You will see that 2 years ago, this business used to trade around 200 to 50 rupees levels. Then in just 1 year, it shot above 2500 rupees, meaning it became 10 times. But after that, there was heavy selling, and since then, Vari has corrected by 60% and now trades around 1100 levels. So if someone made good money during Vari's bull run but didn't exit at the right time, they lost all those returns. So here you need to understand that markets are cyclical, stocks are cyclical. First comes stage 1 where base formation happens, then comes stage 2 in which we see a rally. The company's sales and profits are also growing rapidly here. By stage 3, growth in sales and profits goes away or stabilizes, but the share price keeps running ahead of fundamentals. We see a little bit more rally. After that comes some price correction and time correction. Otherwise, from there, the script enters stage 4, which is the correction phase. Now, there is no guarantee how long a company will stay in stage 4. It can take from 5 to 6 months to even 5 to 6 years. For example, across the world from 2004 to 2007, the real estate sector had a big bull run. Valuations were at all-time highs. But if you look at NCC's price chart here, after it corrected from that peak point of 2007, it took 14 years, mind you, 14 years to come back to the same level. So corrections can last for years, and if you don't exit at the right time, you can get stuck in that business. Similarly, let us look at DreamFox. The first negative news about DreamFox came in September last year when their services were disrupted at several airports. Then in July, Axis Bank and ICICI Bank ended their partnership with them. After that, DreamFox has continuously faced many problems. So where at one point investors had only 15-20% capital loss, now they are sitting with almost 70-80% capital loss. That's why I am saying that with an exit strategy, not only your profits will be saved, but your capital loss will also be minimized. Now let us look at the exit strategies. I will now tell you my 6 exit pointers. The first and easiest exit point is when a script rallies so much that it starts trading at very high valuations. For example, Trent was trading at more than 200 PE at its peak. Since then, it has fallen 40 to 45%, and even now it trades at a PE of 100. To understand PE ratio in very simple words, it means the number of years of profits it will take you to recover your investment. Here, 200 PE means that if you are buying Trent as a business, whole business, it will take you 200 years of profits to recover your investment. This becomes an impossible case. Its share price has gone way ahead of its fundamentals. What happens is people stop looking at the company from a business perspective. Instead, storytelling takes over. Stories get built like solar is a futuristic sector, semiconductors is the next big theme, railways will keep growing for decades, and so on. People just track share prices. They say they bought it at 2000, will sell it at 4000, made 100% return. Now they will buy it at 6000 and sell it at 12,000. It doesn't work like that. For any business in the long term, sustaining PE of 100, 150 becomes impossible. Then two things will happen. Either its share price will crash or correct sharply, like it happened in the case of Trent, or it will go through a long time correction phase, meaning the script just stays sideways. Asian Paints is a very good example of this. You can see in this chart that Asian Paints has been sideways for a long time. It has gone nowhere in the last 5 years. Now we won't go into the details of what happened in Asian Paints or in Trent. That is a separate discussion. But just understand that when you buy a business at 100, 150 PE, the first risk is that the growth or gains it could deliver in the future have already happened or have already come in that business or that stock price. You are late to the party. You will have to admit it. The second big risk is that you are betting that the business will keep growing rapidly for the next 3 to 5 years without any problems. No problems with margins, no problems with growth. That is impossible again, because in business you will have surprises. So even if one problem arises, and it will, then you will face a heavy drawdown. Now, the second big reason to sell is slowdown in growth. This is a very important concept that even many experienced investors don't understand. For this also, let us look at Trent again. In their quarterly results here, you will see that at one point of time, this business was growing at 50% rate. Then the sales growth fell, and by September quarter of FY25, it was 39%. Then in December quarter, it dropped further and sales grew 34% compared to last year. In March quarter, sales growth was 28%. It fell again. And in June, very bad numbers came. Sales growth was just 19%. You see how Trent went from growing at 50% rate to just 19%. You can understand this through the example of train speed. Earlier, Trent was moving at 50 kilometers per hour, an express train. Now its speed is 20 kilometers per hour only. So earlier the market was giving it a high PE because high growth was coming. But now Trent is no longer a growth stock. So the market will not give it that premium or expensive PE anymore. But people don't understand that. Many people think that Trent has become cheap. It is trading at a discount. No, it has become a growth trap for you. There is still growth in the business, but not the kind of growth which was there earlier. So you need to be very careful with such businesses. Next, there can be a case of temporary exit. Temporary exit means that a business or a sector is very good, but because of some short-term problems, you are booking profits and exiting. This personally happened with me in PG Electroplast. So let us understand with its example only. You may remember that last year was very good for all AC and cooler companies because of a heat wave. So very strong sales growth happened and everyone made good returns. But what happened was that this year summers got delayed and monsoons also came early. I remember I was in the con calls of Blue Star and Voltas in May, and their management also said the same thing, that season would be weak this time. By then, PG's March quarter results were not even out yet. But after hearing Voltas and Blue Star's management, I decided to sell PG Electroplast. On the day its Q4 results came, I remember stock was up, I think 5-7%. Results were good, but in the management con call, they gave a surprise. They also said that even though March quarter results were good, FY25 would be weak. And then the very next day, PG corrected heavily. Since then, it has halved in value. So those who didn't sell PG at the right time lost all the returns they made in the last 1.5 year. Now, it is not that the electronics manufacturing sector is bad or PG is bad. Long-term scope is there, obviously. But you need to understand the business cyclicality. You need to track your exit points and then re-entry points carefully. And I know I keep saying this again and again and you don't listen, but still, as a humble request, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simply Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video and also subscribe to our channel as well. Now, the fourth exit strategy for me is if I find a better opportunity. It could be in the same sector or in another sector. For example, Raghav Productivity Enhancers has been my portfolio stock for the last 1.5 year, and since the past 4-5 quarters, it has been giving good results consistently. It had also gone up a bit, and I also invested a little more. So it had become around 4% allocation in my portfolio. But then I saw a better opportunity in power transmission stocks. So I shifted almost 75% of the amount from RPEL into them. And this is what I explain to many people, that don't get attached to the 50-100% return that you have already made. Always look in terms of the future. From this point or from today, which business can give me the best returns? You have to ask this question to yourself. If 1 lakh has become 2 lakh, now you need to see how to make that 2 lakh into 3-4 lakh. Now, the fifth exit point, which happens with many people, is when a business becomes too big in their portfolio. For example, let us say you gave 6% allocation to some business, that business rallies 200%, and then that 6% script becomes 15% of your portfolio. Having 15% of your portfolio in just one company is obviously very big, risky allocation. So you can cut that 15% down to around 10%. The first benefit is you are saving some of your profits. In a way, you are averaging out and selling. And secondly, your stress will reduce. I have often seen that when a business becomes a big allocation in the portfolios of people, they start getting very tense, which is natural. But you don't want to earn money by ruining your sleep, right? So if you are feeling anxious or checking your portfolio 5 times a day, then cut down that big holding a little bit, risk will reduce. Now, the sixth and final exit signal is when something negative happens in that business. You will find countless examples of this. Gensol, Greenfox, IEX. If you go a little further back, Yes Bank and Idea are very famous examples. I was also invested in Gensol, and I would say investing in Gensol was not a mistake. The mistake was that when problems started coming in that business, I kept holding it. I agree, selling a business at 40-50% capital loss is very difficult. The mind doesn't accept it. But then that 50% loss becomes 60, 70, 80% capital loss. My learning here is this: if negative news comes in a business and you are not smart enough to understand how much impact it will have on the business, then quietly take an exit. That's all. It will save you whatever is left. Now, if you like this video, do give me a thumbs up. Along with that, you can also subscribe to our channel Simply Stocks. Your likes and subscribes are our only motivation so that we keep bringing this research to you for free. I'll see you in the next video. Don't forget to like and subscribe to the channel. Happy investing.